Hello, everyone. This is Jeff Weber with the latest in our continuing series of AIM Education Zoom webinars. I'm happy to tell you our topic today is going to be the new 2028 LEAPS and the latest information on the leveraged ETFs. The new 28 LEAPS followed the pattern that has continued for several years of new LEAPS coming out the third Monday in September. So the LEAPS came out last Monday. The brokers have immediately updated their files. So if you look at your iPhone or Android phone, you should see your broker having listed the new 28 LEAPS at the bottom, probably right below the 27 LEAPS. Now, this means that those LEAPS that came out, as today is the 20th, get this, those LEAPS do not expire until January 21st, 2028, which means they still have 2 years and 4 months before they expire. And adding LEAPS to Robert Lucillo's original AIM method that he did with stocks has been a continuing feature of my AIM growth as I learned better and better investments that make you higher and higher profits. And the latest version of that is about 5 months ago, Dirixian introduced a whole bunch of single stock leveraged ETFs. And they're very slightly leveraged. They're only 2 times leveraged. So for example, Apple has a single stock electronically traded fund or ETF. The symbol for Apple is AAPU. Apple, Paul Union. Now, why would we like leveraged ETFs? First of all, there's no commission on them ever. You trade for free. The broker is your friend. Second of all, several of them, including Apple, pay a very high dividend in addition to the capital gains you will get by trading them. And later on in the broadcast, you will see examples of people who are doing AIM with leveraged ETFs and see how well they are doing. Overall, I started a portfolio. Okay, scroll back up. We're in the leveraged LEAPS now. So scroll back to the top. There we go. Okay. Now you see this is the list I compile on a monthly basis and offer for sale for $95 a month, along with a weekly list of 10 combination, 6 LEAPS, and 4 leveraged ETFs. And to make it easier for you, you can see I have color-coded the stocks that were bought that are currently less than $25 a share, which means the LEAP on them will be much lower. Normally, a LEAP is about 25% the cost of the stock. So it gives you a good starting point to search for stocks that you can afford or in your price range and that you like. And you see, even for the stocks, every stock that had a 2% or higher dividend, I listed in the far right column, highlighted in pink, with the percent that the dividend is paying. So if somebody doesn't want to trade LEAPS, we have two alternatives, either a stock with a high dividend, like you just see FAZ has a 6.42% dividend, and leveraged ETFs, which many have dividends, some do not. Now, here's what I did to start with, okay? When you see the current price, 52-week, high, low, and 1-year estimate, that still reflects the 2027s. Why? Because I only do them at the beginning of each month, so the next list will be done the 1st of October. And Yahoo Finance takes a week to actually list the information I need to easily get the current price, 52-week high and low, and the 1-year estimate. So you will be able to research these in more detail next week on Yahoo Finance. And if you have any questions on how do I do that on Yahoo Finance, I'd be glad to walk you through it. Just give me a call at 210-478-0655. I'll repeat that because I know it's hard to write, and talking is always faster than writing. 210-478-0655. But what I found quickly I was able to do, I used my broker E-Trade, and I found that virtually all of the 27 leaps had 28 leaps. You see the first two, Nicola and Canu, do not have leaps, but they're both kind of in bankruptcy, I think. So, you wouldn't want to buy them anyway. I just list all the ones by price. It doesn't mean I recommend all of them. But these are the best of the leaps, because normally there's a total of about 500 leaps, and I am only cataloging about 180 of them because they have sufficient ownership, they trade actively, and they offer you a lot of action. As you can see, many stocks have dividends. So if you like the idea of just doing it with stocks, you can. And you can see even a stock, for example, look at Pfizer, for example. Its current price when I wrote this was 24.60. Its 52-week low was 20.92, and its 52-week high is 30.43. So it's still not at its high for the year. And if you own one of these for the next couple of years, it won't matter. Believe me, they will show you plenty of action up and down. And what I do with them is to make it even easier for you. Every week on Friday, I compile a list of my top 10 combination LEAPS and leveraged ETFs that offer you the best chance right then and there. Because I only have time, being a one-man band, to do the master list once a month. And you can see all the ones in green are ETFs that have LEAPS. Most of the LEAPS we're going to talk about later, the leverage LEAPS, do not have LEAPS on them. Maybe one or two do, but most of them don't. And like I said, they're 2 times leveraged, and they're eternal, just like a stock would be. It would take I don't think Apple's going to go out of business in the near future. So I think the Apple leveraged ETF is going to be good forever. And you'll see amazing price swings when we go down and look at those. As you can see, there's plenty of them that do have good dividends. There's plenty of them that have leaps on ETFs. So you can see it's quite comprehensive. A lot of these stocks you've heard of, they're household names. Amazon, there, I've heard of them. GE Aerospace, I've heard of them. McDonald's, I've heard of them. So you can buy a lot of your favorites. Okay, now you can stop here for a second, Brett. Stop. Okay, here's the beginning. You see it starts on line 185. This is the list of about 40 leveraged ETFs that I like. As you can see, it, okay, stop. Stop. Okay, I wanted to show, now you see, for example, there's both individual stocks that have ETFs, and then there's whole industries. For example, you look at line 195, you see daily uranium industry. Uranium is in the news. And I want to stop and show some of these to illustrate. Look at uranium, for example. Within the last year, the uranium URAA had a 52-week low of $8.73. You see that? Its current price right now is $35.77. That's like a 300% gain. And you see its high for the year is 38.78. So it's near its high. So ideally, if you're going to own it for the next 10 years, it doesn't matter when you buy it. If you plan to own it for just a briefer period of time, we would look for one that is a little better price. And I'm going to show that to you right now. Okay. For example, go down to AMUU. Again, leaps are not applicable. AMUU is the single stock ETF on Microsoft. I'm sorry, not Microsoft. Hold on. Advanced Micro Devices. Look at that one again. Look at the low was $11.12 on AMUU. Currently it's $39.57, and the high is $50.61, and it pays a 2.68% dividend. These dividends are paid quarterly, plus you get a bonus dividend in December. So it's a pretty good deal. You're not paying a nickel for a commission on these trades, and you'll see that that pays off for you later on because you get a very high number of buys and sells on these, because I have a special adaptation of AIM investing that I use for leveraged ETFs. I'll explain it to you quickly. On most leveraged ETFs, since they're all only 2 times leveraged, they're volatile, but not super volatile like the LEAPS are. So here's what I do for them. For the leveraged ETFs, let's say you buy a leveraged ETF at $10. I'm going to use a 10% drop for your next buy and a 10% rise for your next sell. And I'm going to use a 0% safe. So let's say you buy one at 10, very simple. 10% of $10 is $1. You would buy as many shares Again, it's going to tell you exactly how many to buy and sell and at what price. So again, it's scientific and not emotional. You always know what you're supposed to buy and sell, and you will make an average of probably 35–40% a year, especially after the first 1 or 2 years when you're compounding higher and higher amounts of money. That's the secret to making your portfolio grow, is to compound prior profits into future profits. But you can only do that if you're making prior profits. And this method with AIM will make you very high profits, both from the combination of getting the dividends and the fact that your portfolio is growing and growing. So, and again, look at Microsoft. Here's a good example. It was 2506 sometime within the last year. It doubled to 5181, and again, it's high as 5270, but it also has a 5.35% dividend. So think about that. If it's, say it's selling for $50, you're getting $250 a year in dividends times the number of shares you own. So if you owned 500 shares, you're getting 500 times 250, over $1,000 a year in dividends. That's going to help your portfolio grow. And your dividends do not get reinvested back into the leveraged ETF. We decide when we're going to do it based on AIM. So you just put any dividends into your money market with the broker, and it just lets your cash grow. And then we decide what to do with the LEAPS, with the ETFs ourselves. And again, it's very simple to trade. I can teach anybody to do it, and it's very repetitious. So once you've traded 3 or 4 times, you'll be able to do it in your sleep practically. And you can see I started a 10 stock portfolio in my monthly newsletter, and incidentally, everybody will get a copy of my latest newsletter, and you'll see for yourself the amazing results of a 10 leveraged ETF portfolio. In 5 months, it is up 37%. And I've only had one dividend, and that was in September. Like I said, they pay quarterly dividends with a December bonus dividend, which I believe reflects the fact that investments like this have to return 90% of the profits they make to their shareholders. That's the only quick reason I can think of why you'd get a bonus dividend in December, but we'll take any dividend they want to give us. So you can see as you scroll down, they're Dirixians. I emphasize they're not LEAPS, which means they will never expire. That's the only problem with LEAPS, is they do have an expiration date, and very few can come back to bite you as they get nearer and nearer. But I tell people, even with LEAPS, never give up, because I had a bunch of people who owned Intel 26 LEAPS, which are still current because they will not expire until January 27. So you still got a year, and plus some. But I like to roll them over when the new ones come out a year later. And since the new 28s are out, anybody who has a profitable 27 LEAP right now, even if it's $400 or $500, I'm telling them, I want you to sell that 26 LEAP, and we're going to buy a 28 LEAP with it. And now we'll have 2 years, 4 months to make profits on that one. So you really own exactly what you owned before, but you bought yourself another 2 years, 4 months of time. And that's important so that we, have more leverage to decide when to buy and sell without having to worry about them expiring at some point. Again, you'll never have that problem with the leveraged ETFs. So again, you can, if you really like one and feel I'm going to be owning this in 10 or 15 years, and ideally, if you own one of these for 15 years, or even own several of them, I almost feel I could guarantee you will be a millionaire if you reinvested all of your compounded profits. And I have one great example of a stock that I looked at for 15 years that was as volatile as a leap, and that was Crocs shoes, CROX. I started with 5,000 in cash, 5,000 in stock, which was like 350 shares. 15 years. Originally, I wrote my first book, I Guarantee You Will Buy Low, Sell High, and Make Money. And I'd be happy to send a free copy to anybody who wants one. You can write me at jeff@jjjinvesting.biz, and I'll send you the book, and I'll even send you my latest free master list and my free weekly list of 10, and you can see if you think it's right for you, and then you can start subscribing for $95 a month. And I'll give you a nice bonus. I will give you a free copy of my $500 value 5-hour AIM course for free if you subscribe to the LEAPS lists, which you will get every Saturday at the latest, and they will be accurate and up to date through Monday, because they will have the prices that the LEAPS and the ETFs closed at on Friday. So you have all weekend to look at them. And again, anybody who has a question about them, I'd love to show you any LEAP or ETF you're interested in on Yahoo Finance once they get all the data in next week. And I'll show you how I analyze both leveraged ETFs and LEAPs and why I like them or don't like them. So you get the best of all worlds. You get the basic AIM course, which will teach you a lot of stuff I probably didn't even cover, and you will get answers to any of your questions, because I know many of you are very new to this, and you probably have a lot of questions or doubts and think that this sounds too good to be true. But I've been doing it for 18 years with LEAPS, and I've been doing it for 5 months with leveraged ETFs, and I can tell you it works, and I'm the real thing. I want you to have a good life. Economic conditions are not going to really get better again soon or ever. I don't know. So I tell you from the bottom of my heart that everybody needs a good side hustle, because there's too many unknown factors in the future, and too many people are losing their jobs to artificial intelligence, robots, I don't know, whatever. So it's going to be harder for you and your children. So I urge you to learn this, not just for yourself, but so you could teach your children and your grandchildren, because this will work 50 or 100 years from now when I'm long gone. And it's easy to learn. And the good example of how it's easy to learn, my friend Mark was an investing person. He had never heard of LEAPS or, anything years ago in 2020. He contacted me. I talked to him. He had faith in me. He liked my ideas. And he he used to vacation in Mexico for a couple of months a year, and he lived in Portland, Oregon. Well, he was getting tired of Portland, Oregon, and the rain and the high costs and the crime. I don't know whatever. I've never been there. I don't know, but he had faith in me, and so I started teaching him AIM investing with LEAPS in January of 2020. Again, like I said, he started with like 520,000 or something. Well, long story short, I helped him for about 6 months through June. By June, he said, I have learned this well enough, I can do it myself. So he did it himself the next 6 months till December. Well, he was so happy, he sent me a detailed weekly profit checklist, how he had done for all of 2020. And basically, he went from 520,000 to 1,750,000. And that's because it was a very bullish year. Now, I'm making good money for people now in not a great bullish year. It's an up and down year. But LEAPS and leveraged ETFs are perfect for this kind of market because you get small dips all the time and you get small rises all the time. So I would say on average and you'll see when we look at the spreadsheets of a couple of my clients who are in leveraged ETFs right now, how well they're doing. And you see, you get a lot of buys and sells. And again, no commissions on any of them, whatever. So I think we could explore over to the spreadsheet now, Brett. Pull up the Google one from which should be Gene. Okay, here's an example of how I do a leveraged ETF. If you're familiar with AIM, you see the spreadsheet is very, very similar. We make a few important modifications. First of all, when you look in the remarks column, you see it's an ETF, it's Google. The symbol for the Google ETF is GGLL, which is different than the symbol for Google, which is GOOG. And you see, I put a note, it's a 10% buy and sell. So, for example, my friend started with 150 shares, okay? Again, no commission, okay? So the first row is pretty similar. The value was 58.95, which is 150 times 39.30. Safe is 0. And I have found you don't need as much cash with a leveraged ETF as you do with a LEAP. So I basically adopted the rule of going 1/3 cash, 2/3 ETF. So you owned 150. Again, portfolio control is always equal to your starting amount. So it's 58.95 LEAP, ETFs, 58.95 portfolio control. You don't do anything the first month. You just put dashes for buy and sell advice, 8,000. Now, what I did originally, I wrote the same as I do on the LEAPS. I write the buy and sells so you have exactly what to do. And I'll talk a little bit about that in a minute, about a wrinkle I put on that makes even higher profits. So the first time we get any action, you see your LEAP goes from 39 to 45. That's more than 10%, okay? So at the time, the bottom buy and sell at that time, told you to sell 10, and you're making about a $6 profit times 10, $60. Basically, with leveraged ETFs, you're jabbing your opponent all the time, and you're going to win the fight on points. You're not going to show the knockout right cross like you would with leaps and hit the big bucks. But if you can average 30 or 40% a year over time, I think you'll be very happy, especially once the compounding starts kicking in. So, okay, so 8,500. So now when it went to 4,500, now your ETF value jumps to 6,750. Okay. Now you don't adjust the cash. I do the same thing with the leverage ETFs I've always done with the LEAPS. I have the top row that reflects the buy or sell, and then right below it on the same day with the same strike price, I do the admin row and adjust all the features I need to adjust to have accurate information to figure out the next buy and sell at the bottom. So you see in that, okay, you see in that row, because we have a 0% safe, the buy and sell advice and the market order buy and sell are always identical. So AIM told you to sell $450 worth, which is the value of 10 shares. So 430. And then you do just like you do with all AIM things. You add the ETF value, you add the cash, and you see your portfolio has grown from 8,500 to 9,355. Okay. And I have to tell you, since April, we have been in a bit of a bull market. A short bull market is great, is great to offset many months of a bear market. So we take advantage of it, and that's why you never know, tomorrow it could go down. That's what's good about AIM for any variation, is it's always turning paper profits into real profits. So now you see, you look down and see by August 29th, less than a month, you have a second sell. The price of Google ETF goes up to 50. It started at 39. It's up 20% already. The value of that is that you now own 140 shares times 50 is 7,000. Again, safe is 0. You see your cash has grown from 2,605 to 3,055. Very good. You're selling 21. 21 times 50 is 1,050. Again, you see the sell advice and the sell order is the same at 1,050. And you see your portfolio value has risen from 8,500 to 10,055. You're up about 15% in a month. Not bad at all. Beats the hell out of a CD. Okay. And then look how it continues. September 3rd, it's 55. You get another sell for 21. Again, now you see you're reducing your risk because now you only own 119 shares. And again, you see, whenever you have a sell, your portfolio control never changes. So you're doing about 90% the same with a LEAP as you are on a leveraged ETF. It's just a few minor modifications that make more sense for an ETF than for a LEAP. So now you're up to 10,650. You've already made a $2,100 profit in 1 month and 2 days. Not bad. That's like 25% profit. And finally, the last one is 65. So you're in a month and a half, roughly, your ETF has almost gone up 50%. So and again, look what your cash has done. You have more than doubled your cash in a month and a half. You went from 2,600 to 5,500. So you're constantly reducing your risk, increasing your cash. And if it ever gets to the point where cash goes to be more than 50% of, I'm sorry, more than equal to the LEAP value, we can take the excess cash and buy more leveraged ETFs to make our profits even quicker. So there's all sorts of tricks I can do for you when I'm managing your account. And I want everyone to know I still manage accounts and will be glad to get you started with at least 6 months of AIM, preferably a year, and you will learn all the tricks of AIM. Okay, put up the other one, Brett, the Tesla one.
Okay, thanks, Jeff. I do want you to know we have several questions that have come in, so
Oh, sure.
if
Let's, you want to
maybe we
take a few
show.
questions? Sure.
All right. We'll start with Clint. He asks, he's curious why you prefer individual stocks over just doing it with TQQQ or SOXL, for example, or UPRO.
The
Um,
first reason is simple. It's because the leveraged ETFs never expire. I don't have to worry about time decay on them. The second reason is it's very simple to do. There's no commissions and they make very, very high profits. And there's a bunch of people out there that would never buy an option in their life because they have been badmouthed by so many experienced, licensed financial advisors. No financial advisor will ever tell you to buy an option. Believe me. And they're costing you very high profits that you would make with AIM on options. I personally would never tell you not to buy an option. But again,
okay.
you run into that time decay problem. And that is the main reason why. I think ideally, if you could afford 10 different investments, ideally you would have 6 LEAPS and 4 leveraged ETFs. So you can definitely have TQQQ in your portfolio. Right now, TQQQ is at its 52-week high. It wouldn't be the best time to buy it if for a leap, but if you plan to continue to own it, I think you could buy it now, and you're likely to get your very first trade as a buy because it's so high. But again, we never know when the high is going to start going lower. So, yeah, you could do that. And there's several other ones like that. But most leaps, most stocks, and most ETFs right now are very high. So you have to think long term, and then you could buy almost anything. But I always, that's why I publish my weekly and monthly lists to try and give you an idea of some that are cheaper right now and you could buy. For example, look at Home Depot, for example. That's been low for a long time. And that's a very good leap. And I think that will, rally fairly soon. Next question.
Okay. Okay. Thanks, Jeff. All right, next question is from Mike. He asks, the ETFs, do the ETFs follow the underlying stock? So can you still use the underlying stock charts to guide your buy and sell point? Or how
Yeah.
better to
Oh, yes, you
to,
can, because the ETFs are actually a mirror of the stock. Think of it this way. If Google's stock goes up 5%, your Google ETF GGLL will go up 10%. It's an exact mirror. It's just leveraged 2 times. Plus, many times the stock itself doesn't pay a dividend, but the ETF on the stock does pay a dividend.
okay, but I think maybe what Mike is missing is the automatic part of AIM. So explain how once you make your initial purchase, you calculate the next buy and sell point ahead of time, so you don't need to watch the price.
Okay, yeah, well, go back to the Google one and I'll explain it showing that example.
Okay.
That's what I meant to do before it disappeared.
All right. Stand by.
Any one of them is good, but the Google one is easier to look
Okay.
at. Okay, let me explain how I got you see the buy and sell at the bottom, separate from the daily looking. Okay, you see here, I'm telling you to buy 47 shares at 48.75 and sell 12 at 71.50. Well, how did I get that? Very, very simple. The last price, I always use the last price. So the last price was 65 when we had the sell for 4. I take 65, I multiply it by 0.9 or 10% less, and I get 48.65. And then I multiply 65 times 1.1 and I get 71.50. Then I multiplied the number of shares. You see how the last recorded ownership of shares was 94. I pull that down. That's why I do the admin row. So I always have the information I need. I see that the portfolio control has never changed from starting a month and a half ago at 58.95 because we only had sells. And when you have a sell, you never adjust your portfolio control. You only raise it by half when you have a buy, which I'll show you on the Tesla.
Yeah, hey Jeff, I think uh we might have a mistake here because this 71.5, that looks like a 10% over 65, but this number is too low. 48. That does that
Okay,
make sense to you?
I could be a typo. I
Yeah.
have Okay, let me see what it should be then. Okay, but you see how you do it. Okay,
It's times point 0.9, right? You
yeah,
do a
so it
10%
would
drop.
be,
Oh, there it is. There's a typo there. Yeah.
just a typo. It should be 58.5.
There we go.
There you go. Okay,
Okay.
now, so you got to be careful with your calculator.
Yeah.
Believe me, you do a bunch of these, it's very easy to make mistakes. So I constantly correct my own mistakes, and every now and then I correct somebody else's. So, and again, there's 2 ways to do it once you set it up correctly. Now you see you want to buy 7 at 58 and you want to buy 12 at 71.
And
This
then,
would
so then
be
explain, Jeff, please, how once you know these prices, you make a limit order, so then they happen automatically.
no,
Right?
I'm going to talk about that. Okay.
Okay, good. Yeah.
There's 2 ways to do it. I have found my way is better. Okay. Originally, with all AIM, I was doing it on a daily basis, whether it was a LEAP, an ETF, or a stock. I have a few people who do it with stocks that pay high dividends. Okay. Here's what I found. First of all, I'm a one-man band here trying to do all this, and it gets a little overwhelming. So I decided to change my rigmarole, and I just look up people's stocks, ETFs, and LEAPS every Friday. Because when Lucillo invented AIM, he only did it once a month. So I thought I'm being generous to do it once a week. And what I found is this: you make a higher profit checking it once a week than you would have by executing exactly at the 10% higher or lower. So I'll give you an example. For example, I had a guy, when we figured his next buy, let's say it was $20. Well, we waited, he wanted to do it every Friday. So we ignored when it got to $20 and we looked at the price 2 days later on Friday. Then it was $18. So we bought the same number of shares that we had originally decided to buy, but we only bought them for $18 instead of $20. So most of the time, you will get a lower low and a higher high if you just do it once a week on Friday. And that's the way I now recommend you do it.
Okay. Thanks, Jeff. So
Okay, now
here, let
flip
me
up Tesla here.
well,
I
Jeff,
want to
how
show
about we
people a
found
buy.
somebody else pointed out another, looks like a typo or mistake. You notice how these are all cells, right?
Right.
But so shouldn't this be negative here because it's a cell? The others are
Yes,
negative,
because you have a negative on the 21. You should have a dash in front of that.
right? So that's another update correction to make on this, right?
Yeah. Now, see, you added the cash correctly in the cash column,
Yeah. So
41 to
maybe
52.60.
maybe the other numbers are correct,
That's
but this one,
the portfolio control is correct.
yeah.
It
Okay.
never changes because we never, so you just need a dash in front of that.
Just want to. Okay, good. All right. Well, Jeff, there's we still have some questions, so how about we
Okay,
just
let's
move
go to the
on with those?
questions.
Okay, next is, let's see, from Tracy. She asks, I've heard to be cautious of ETF decay due to rebalancing. Your thoughts, especially as some stocks are near their all-time highs.
I don't recommend rebalancing when a stock is at its high, but what you find after a while is, don't compare your stock or ETF or LEAP to the overall market. Most people get blinded by what the Dow Jones is doing or the NASDAQ is doing. You only want to be concerned about what your particular stock, ETF, or LEAP is doing. And what you'll find when I can walk you through it in better if you're on your computer and we go to Yahoo Finance and I can show you what the charts show you, how the yearly movement is incredibly up and down on each individual LEAP, ETF, and stock. So you'll always get the whole market could go up and yours could go down, for example. So that's why I changed from Lucillo didn't believe in individual spreadsheets. He lumped everything together. I make a separate spreadsheet for every ETF, every leap, and I look at that only to decide on your next buy and sell. And all I can tell you is I just rushed to complete my October newsletter. All 5 portfolios were way up in October. One of my portfolios, the in the money one, believe it or not, in 18 years is up 4,500%. Or I started a model portfolio with about 1,100,000 19 years ago, and it has grown from 1,100,000 to 49 million because of compounding in time and gains on the individual ones. So always view AIM in any form as a long-term method, and you're concerned where you're going to be in 10 or 15 years, not next week. Just AIM will always tell you the right thing to do with anything, with a LEAP, with an ETF, anything, and follow the guide and you'll be very happy. Just for example, I had a guy, we had Intel that had been down forever. It had been down for over a year. All of a sudden, the government bought a chunk, NVIDIA bought a chunk, and my friends, he had originally bought it at, say, $5. It was down at $2. In one day, it went from $2 to $6. He was able to get all his money back and a nice profit after a year of that being down. So I tell people, never give up on a stock. You see that happen all the time where they rally at some point. Even Boeing was down forever and it rallied. So I haven't seen any, even Soxel rallied. So those were three of the worry warts that I had told people to buy, but they rallied nicely and now they're making good money. Give you an idea of the real world. I have a guy who's a pilot who started with me with like 900,000, and he was upset because his financial advisor had dropped his portfolio from about 1,100,000 to 900 or 800,000, I forget exactly. And the guy had never told him anything to buy because my friend is smart. He's a jet pilot and he knows math. And he said, if all of my investments are down, there must be some other investments that are a good buy because they're cheap and they're going to come back. But the guy never called him to tell him about those. I'm the guy who will tell you about those. I'm the guy who'll tell you. Like right now, Apple leveraged ETF is the perfect buy. Why? Because it's down, it's way down on the leveraged ETF price. It's down about $20 from its high. It's paying a 20% dividend every year, quarterly and 2 in December. And it's cheap, you know. So what you find is all you ever have to do is think that the stock market is a roller coaster. Sometimes you might go down longer than you like, but eventually you go back up. And I have found 2 or 3 very bullish months can offset a year of negativity. Look at Intel. In one day, it got back all the losses it had suffered for 1 year and made a healthy profit just because NVIDIA and the US government took a stake in it. It started dropping immediately after that. But again, all you need with a limit order is a split second for the price to be high, and your sell is automatically executed by the broker, even if you didn't notice it. That's the beauty of limit orders. So I swear by limit orders for LEAPS and ETFs because that will make you the highest profits. Next.
Okay. Thanks, Jeff. I think we have time for one or two more questions. Next one is, do you have thoughts on UNH and Lulu leaps? So
Which one?
so maybe for specific stocks or ETFs or leaps, they probably should talk to you in person, right? Let's
Yeah, why
not give
don't you call
specific
me
advice.
on that one? Again, my number is 210-478-0655, and I'll give you my honest opinion on anything, any stock or ETF or LEAP that you want to look at, and we'll look at it on Yahoo Finance together. So be near your computer, and I can do it very quickly for you.
Yeah, and also I'll recommend again the weekly list that Jeff puts out, actually monthly with the watch list. You'll see at a glance the 52-week high and low for everything, and that will tell you where things are. So, yeah.
Yeah, that's always the starting point. And I do the same thing on Yahoo Finance. I look at the 52-week high and low. And again, if you want to see what AAPU looks like, which is the Apple one I'm highly recommending right now, You can go to Yahoo Finance right now, type that in. And what you want to do is you go above the chart because you'll see a chart when you open the page up on the summary page, but it's only for one day. So go above the chart and you'll see a 1Y above the chart, and that will show you how AAPU has done for the whole year, for the last year. Plus, it'll show a little green box how much the stock has gained or lost in the last year.
Okay, great. And here's maybe more of a comment, but a question or from somebody doing AIM with Mike. He says, with AIM strategy, you're he's not afraid of a heavy price drop anymore, but you have to get used to a temporary paper loss that sometimes can be large. Is that, do you agree with that? Or what's your thoughts on that?
Yeah, I definitely agree with that. But again, you had a large paper loss for a year on Intel and many other ones. I honestly cannot tell you of a big loss. I never, and nobody will ever make zero on a leap because before it would ever expire, I would have them sell it, even if it was at a slight loss. Like I had one guy, he owned the Intel forever. It rallied enough, but he was still down. He had been down like $2,000. So he was like at 2,000 instead of 4,000. When we had that one good day, it went up to $6 and something. It hit like 39.80. So he was only suffering a $80 loss. I told him, let's sell it and bail out. I can tell you, going back in history, over 30 years ago, I compiled a list of certain stocks just to see if they would work with AIM from Lucillo 50 years ago. One of the ones I used was Alice Chalmers. Well, Alice Chalmers was one in 3 years. It started at $10. It finished at $3.80, the stock. I don't even think they had LEAPS back then. That was long ago, about 1980. Well, I noticed at one point, okay, at one point the stock was at $3.50. I noticed my portfolio was still up about 55%, we'll say. Much better than the lump sum guy who, if he bought all 10,000, he would be down 65% if his stock went from 10 to $3.50. And then funny, the next month, literally, it went up to $5 from 3.50. So it's worth 50% what you would have bought it for originally. At that point, when you looked at AIM, you were only down 5%, or you still had 95% of the value, 9,500 out of 10,000, even though the stock was only selling at $5 because you've been dollar cost averaging. Think of it this way: AIM is merely a sophisticated dollar cost averaging system that includes buying and selling. Most dollar cost averaging only wants you to buy. I actually had a experienced financial advisor tell me this. He said, here's what little investors should do. You should invest $100 a month and do dollar cost averaging. And he said, the first month the stock is $10, you buy 10 shares. The second month the stock is $25, you buy 4 shares. The third month the stock is $50, you buy 2 shares. You have dollar cost average and your average share price is $37.50. Well, that's fair, but not good. And I bit my tongue at the time, and I felt like saying, hey, if I bought it at $10 and it goes to $50, I'm selling a hell of a lot of it. I don't want paper profits on a 400% gain. I want to sell some of it. So when AIM came along years later, I learned the perfect way to handle something like that. You sell part of what you own at a real profit. You build your cash reserves up for the lean times when the prices go down, so you have enough cash. And I've also got a bear buy strategy I use for lean AIM, I use for regular AIM, and I use for leveraged ETFs when necessary. So you would never need to add more cash to anything. You will be covered forever on it. And I'm happy to work with anybody and explain that one-on-one. Again, I urge you to learn AIM correctly, get my free book. You could even buy my AIM for Millions book. It's for sale on Amazon. Just type in my name and you'll find it, Jeffrey Weber. And I would love to help as many of you as I can, but I can only help you if you want to reach out to me. So again, if you send me your email address to jeff@jjjinvesting.biz, B-I-Z, I will send you my free book. I will send you examples of the of how a leap looks on a spreadsheet, how a leveraged ETF looks on a spreadsheet. And I'll send you my latest list, the weekly list of 10 leaps and leveraged ETFs, and I'll send you my latest list. Probably I'll wait till October to send you the master list, because by then I'll have all the information on the 28 leaps from Yahoo, and I'll be able to send you a complete list of the current price and the 52-week high and low.
Okay, thanks, Jeff. So let me show you everybody. We have an easy way for people to do this on Jeff's website. Here it comes. You can get all those things for free. Scroll down on his page and you see this here, a free ebook, What is AIM Investing? You can get that now. Just look for this on his page.
And that is under products or books or what?
It's right on your main page, your home page. So
Okay.
that leads you here. You get this free ebook. It all explains about AIM. But then when you get that, you'll also get the newsletter for 3 months for free. And you'll get his ebook, this other book, Buy Low, Sell High. And you'll get all that. And then you'll get announcements from our for upcoming webinars. So
Right.
I'll show you
So
right here.
it's a very good deal. Nobody else is teaching this, I can honestly tell you.
It's right
And it
there on
has
his
worked
homepage.
for 18 years, so you don't have to worry about back testing it. And you see
Okay.
the newsletter, you won't believe the gains, but they're true. I don't believe them either, and I'm doing it. It just works. I don't see how it can never not work. It's just, think about it. All the stock market is a giant roller coaster that goes up and down. Like I'll give you one quick
Well, here,
example.
Jeff, can I give you, we have another example from Mike in the chat.
Sure.
He said Coca-Cola KO, the 2027 leaps, it went down 70%, but then it also went up 600% during its life. So it's worth a long wait and you can still have hope.
Great. And again,
Especially a company like Coca-Cola, we know it will stay around, right?
yeah, it will stay around. Let me give you, I have Coca-Cola in a couple of my model portfolios. I can tell you right now, over the last 18 years, when I added Coke originally to my in the money portfolio, it has grown 900% in 18 years. That's an average of 50% a year overall. So I don't worry. In other words, don't worry about the breeze, that comes along, or if it rains one day, it doesn't mean you'll never see sunshine again. Think of it that way. Everything is a cycle in life, day, night, summer, winter, bull, bear. And so AIM is always telling you the right thing to do. If the market is down, it's going to be telling you to buy. If the market is up, it's going to be telling you to sell some. But the beauty of AIM is it always holds some back and lets you sell it at a higher price later. So you get the best of both worlds. And again, commissions are very cheap. It's very easy to do. You can do it anywhere. My pilot buddy, I made him about 30,000 last week while he was flying, because he get to, he might fly from Charlotte to Chicago in his jet, but he has a couple hours where they load a patient and, to get ready to go somewhere else. And so he borrows the airport computer and makes his trades, so you're never out of the game. That's the beauty of AIM. You can trade anytime the market is open. And even sometimes when the market is closed, you're always able to put in a limit order when the market is closed. You just can't make a market order when the market is closed, and that's to protect you, because it could open at a wildly different price the next day or something. So the securities people want to protect you and keep you from doing that. But that's no big deal. I can work with you. I'll give you the best solution for your problem right then and there, and you'll quickly learn from me. Anybody who signs up with me can call me anytime, 7 days a week, up to about 9 o'clock at night. And you will never get voicemail. You will get me, because I'm the only one that can answer your question on AIM in the world, literally. So
You put in the time, Jeff. All right,
you
well,
you will never get better customer service than you get from me with the greatest investing method ever invented.
okay. Yeah, you do you work incredibly hard to help people and be responsive.
So
So,
because that's my goal in life, is to help people, help you have the life you want, even if, circumstances aren't perfect in your financial life. Anybody can start, if you plant the acorn, you grow the oak tree at some point. So that's what you got to think, that any amount of money, and when's the best time to start? It's right now, anytime. And I can give you good guidance on what to buy initially, and you will gradually learn yourself what are the best things to buy, because you'll see countless examples under my AIM management. And you're always welcome, when I update your spreadsheet, to ask me any question if you don't understand something I did on the spreadsheet, and you'll quickly absorb it.
okay, Jeff, well, we're over time, but do you have time for one more bonus question? Because
Sure.
Clint has another question. Okay, and then it's about the market, and then I think we need to wrap up. But this question is, which delta or price are you targeting on the new 2028 leaps, or leaps in general? Would it be at the money, in the money, or out of the money? Any want to answer that?
Slightly in the money is what I'm looking for initially. A lot of my people might own, let's say you own 29 contracts for the 27 Apple, we'll say. What you might find is, to buy the same strike price slightly in the money, it's going to be higher, because normally 28s average 20% higher in cost than their corresponding 27 relative, if you want to call it that. So for example, if the Apple is 34 for the 27, it'll probably be around 35, 36 for the 28, not that much higher. But you're buying that extra year of time, and that's very important. So I advise everybody to roll over. So my buddy might have gone from owning 27 contracts, now he owns 19, for example. So what? It doesn't matter how many you own, it's the percent of profit you make. And I think buying slightly in the money, even for the new 28s, is a good time. And I would say buy now, even though, and here's a way to check on them quickly. If you're going to see very low ownership on the 28s, say you looked at Google and they had 80 contracts for the, I don't know, the strike 200, I don't know, something like that. What you'd find, and that price is maybe $25 on the 28. If you looked at the 27 200, it might be $20, 20% less. So you go from owning, maybe 25 contracts to owning 20 contracts. You spent the same amount of money you got from selling the 27s. You made a nice profit on the 27s. So again, you're compounding more cash in, and you always readjust the cash and leaps, or cash and leaps to a 50-50 ratio. So if you, for example, if you sell, let's say you sell 20,000 worth of leaps and have 30,000 cash, that's 50,000 divided by 2. You want to buy 25,000 more worth of leaps. And you can buy an odd quantity. It doesn't have to be 15. It could be 16. You can even cheat and go 14 sometimes. But I also have one trick. If you want to talk to me about it, I don't have time now. I have a lean method that involves buying 1, 2, or 3 stocks or leaps, whatever. And I say on the leap, one quick example with a lean aim, it works. I've been doing it with people for the last 2.5 years. I have about 800 cells with it. The average cell with lean aim takes a month. All you do is this. I had a guy buy Tesla at $5,000 for one contract. You could see to buy 15 for regular aim would have cost you 150,000 at least. So he bought one for 5,000. You don't put in a buy order. You just put in a sell order for 25% higher. Well, 25% higher than 5,000 is 6,500. So we put in a limit sell for one contract on Tesla at 6,500. He got that sell a month later. That's typical.
Okay, thanks, Jeff. All right, let's wrap up, but we have one more question from Deanna, but it's a great way to wrap
Sure.
up. So she asks about this. I'm going to share about what's included with your weekly, with the subscription to get everything. So here, take a look at the screen, Jeff,
Okay,
and tell
here's
us.
our weekly list of you. You will get this once a week, and you see the detailed information. You have the name of the LEAP or ETF. You see the symbol. That's what you always need to look it up. I show you the exact strike price I like. And when you see open interest, all that means is this is the number of contracts owned. I like a higher ownership. You see, on Apple is 11,202 opened. The closing price, that means that Friday, when I sent this out, it was current. That's the price you could have bought it at the following Monday, 57.93. You see, it's very near its low of 55.90. That would be a good time to consider buying Apple Leaps. And look at the high, 82.85. That's almost 50% higher. So that was a perfect one. AMD, okay. It's a little higher priced. It had lower, I'm sorry, it still had a good ownership. The Strike 100 on Advanced Micro owned 2,072. Look at the current price was $37. The low for the year, or the 5-month low, because I hadn't even done these for a year, was 37. Look at the 5-month high, $90. See how that's attractive. So, and you are welcome to look at any of these and say, Jeff, could we look at AMD or Apple, and you on Yahoo Finance, and you explain it? I would. So you will get, and I will even, I have extra bonuses too. I have an unpublished book that has about 50 leap tricks and investing tricks that will make you even higher money. And you'll get that.
Yeah, that's I believe that's in the when you sign up for the 3 months of the newsletter and the free ebook, you get that too. But here, Jeff,
Right.
also what we started with today in the webinar is your big spreadsheet with all the leaps and the ETFs. That's also what you get at once a month when people sign
Right.
up
The
for this.
beginning of every month, you're going to get that. So if you signed up now, you'll see your first master list in October when I have all the 28 information available that I can list in my master list.
And people can find this, go to his website, jjjinvesting.com, go to products, and then it's the second item here, exclusive weekly list of leaps at historic low prices. So, okay.
Because that's the question I got asked the most through the years. What's a good investment now for AIM? And it was very hard to go one-on-one and figure it out and something. So I thought, why don't I come up with a better way to do it that it's easier on me and easier on you? And I figured out this is the best way to do it. And again, I give you a great starting point to find a couple that you might think are good, and then I can show you exactly what to do. And we'll do it live. So because you never want to buy a leap unless you're looking at the price that day. It can change in one day. If I mean, you would have hated to sell your Intel at $2 when it was going to go to $6 the next day. So I can tell you what the price is right now and whether we need to put in a limit order or a market order, depending on the kind of high-low tightness. In other words, if the low is $20 and the high is $20.20, we can make a market order. If the low is 20 and the high is 30, we don't want to put in a market order because you might be buying it for $30 instead of 20. So we would put in maybe a limit order at $20.50 or something. So that's the kind of things subtle AIM tricks I'm going to teach you that you will learn quickly and be able to do for yourself a month or two in the future.
Okay. All right. Thanks, Jeff. Well, appreciate the time and info here. I think everyone else does. So, and of course, you can contact Jeff with more questions and anything else you want to say as we wrap up, Jeff?
Yeah, I want to wrap. Please, anybody who has a question that needs answering or I didn't answer fully, I would like to, work together in Yahoo Finance on anything. Please call me at 210-478-0655, and I'd love to help you. That's the whole reason I started this. Originally, I was just trying to find a great way for me to invest, but I found that this is so good and I've expanded it using my brain through the years. I think it's pretty flawless right now, and it's going to get you 5, 10 times the profits than any established method is going to do. You don't want a CD that pays 1.5%. Those days are gone, where that would ever help you, because of inflation. So if you're not making at least 6 or 7% a year, you're losing your money because inflation is 6 or 7% in real life, whatever. Look at the gas pump, look at the grocery store, and see if you can get by with a CD interest rate. You can't. So I want to help. Call me. I'm here. That's why I do this.